Last April, a retired couple in Ohio sat at their kitchen table and opened their tax return. They owed the IRS $4,700. They were stunned. They live on Social Security. They barely spend anything. How could they owe that much? So they asked a neighbor for help. That neighbor told them to get a second opinion. A different tax preparer looked at the same paperwork, same income, same documents, same year. But this time, they owed nothing. In fact, the IRS owed them $380. The difference? 5 deductions and credits their original accountant never applied. 5 things that were sitting right there in the tax code, in plain sight. I am Edward, and I am a senior policy analyst specializing in retirement finance and federal tax rules for older Americans. Today, I am going to walk you through 5 specific tax deductions and credits that most accountants either overlook, misunderstand, or simply do not know how to apply for seniors. Now, let me be very clear about something. I am not going to share rumors. I am not going to guess. Every single fact in this video comes directly from IRS.gov official publications and AARP.org. I will reference the exact publication number so you can verify everything yourself. But here is what I need from you. Please stay until the very end of this video, because the 5th item on this list is the most underclaimed tax benefit in the entire federal tax code. Millions of seniors qualify for it. Almost nobody files for it. And if you leave before I get to it, you might be walking away from up to $7,500. Let me tell you about Robert. Robert is 68 years old. He retired 3 years ago from a manufacturing company in Michigan. He gets Social Security. He has a small traditional IRA, and he has been going to the same accountant for over 15 years. Robert trusts his accountant completely, and honestly, his accountant is not a bad person. He just does not specialize in senior tax rules. So here's what happened last year. Robert sold his house. He had lived in that house for 31 years. He bought it in 1994 for $110,000. He sold it for $590,000. His accountant calculated the gain as $480,000. Since Robert is single, the Section 121 exclusion covers $250,000. That left $230,000 in taxable capital gains. Robert's tax bill? Over $34,000. But here is what the accountant missed. Over 31 years, Robert put a new roof on that house. He remodeled the kitchen. He replaced the furnace twice. He added a bathroom in the basement. He installed central air conditioning. He put in a new driveway. All of those are capital improvements, and they add to the cost basis of the home. When Robert finally gathered his receipts and records, those improvements totaled $86,000. His adjusted basis was not $110,000. It was $196,000. The real gain was $394,000. That is $144,000 in taxable gain after the exclusion, not $230,000. Robert still owed some tax, but it was over $12,000 less than what his accountant originally calculated. That was just one mistake on one deduction. Robert's accountant also missed 4 other benefits we are about to cover right now. Deduction number 1, the Enhanced Deduction for seniors. This is brand new. Most accountants have never filed a return with it before. Under Section 701103 of the One Big Beautiful Bill Act, which was signed into law on July 4, 2025, any taxpayer age 65 or older can claim an additional deduction of up to $6,000. If you are married, filing jointly, and both of you are 65 or older, that doubles to $12,000. This is documented on the IRS website. They published a dedicated page on February 27, 2026, titled, "Check Your Eligibility for the New Enhanced Deduction for Seniors." Now listen carefully. This is not the same as the regular higher standard deduction you already get for being over 65. This is a completely separate additional deduction. It goes on its own line on your tax return. You can claim it whether you take the standard deduction or you itemize. Here is the trap. Many tax preparers are treating this as if it is already included in the standard deduction. It is not. If your accountant did not put this on a separate line, you may have left $6,000 in deductions on the table, but there is an income limit. The deduction starts to phase out if your modified adjusted gross income is over $75,000. For joint filers, that number is $150,000, and it disappears entirely at $175,000 for single filers or $250,000 for couples. And pay attention to this. If you did a Roth conversion last year or sold stock or had any spike in income that could push you past the phase-out threshold without you even realizing it, this deduction is only available for tax years 2025 through 2028. So you have a limited window. Do not waste it. Everything I just told you is documented in IRS Publication 554, the Tax Guide for Seniors. Deduction number 2, medical and long-term care expenses. If you itemize your taxes, you can deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. Now, most seniors hear that and think, I take the standard deduction. This does not apply to me. And in a normal year, that might be true. But what about the year you had hip surgery? What about the year your spouse moved into a nursing home? What about the year you paid $8,000 for hearing aids and $5,000 for dental implants? Here is what qualifies. Medicare Part B premiums, Part D premiums, Medigap premiums, nursing home costs if medically necessary, long-term care insurance premiums. And for 2025, if you are between 61 and 70, you can deduct up to $4,810 per person in long-term care premiums. If you are 71 or older, that goes up to $6,020. Hearing aids qualify, eyeglasses qualify, dentures qualify, transportation to medical appointments qualifies at 21 cents per mile for 2025. And here is the one almost every accountant misses. Home modifications for medical purposes. If you installed a stair lift, grabbed bars in the bathroom, a wheelchair ramp, or widened your doorways because of a medical condition, those are deductible medical expenses. Many accountants code those as home improvements and never mention them. But IRS Publication 502 says clearly, if the primary purpose is medical care, it qualifies. Let me show you how powerful this can be. Say you are a single senior with $50,000 in adjusted gross income. 7.5% of that is $3,750. If you had $30,000 in nursing home costs last year, your deductible amount is $26,250. That is far more than the standard deduction of $15,750. Itemizing saves you real money. And remember, if you missed this deduction in a prior year, you can file an amended return using Form 1040-X. You have 3 years from the original filing date to go back and claim it. After that, the money is gone forever. Deduction number 3, the home sale exclusion and cost basis adjustment. I already told you Robert's story, but let me give you the rule clearly. Under IRS Section 121, when you sell your primary home, you can exclude up to $250,000 of gain from taxes. For married couples filing jointly, that exclusion is $500,000. You must have owned and lived in the home for at least 2 of the last 5 years. This is all documented in IRS Publication 523 and IRS Topic Number 701. But the critical word here is gain. Gain does not mean the sale price. Gain means the sale price minus your adjusted cost basis. Your adjusted cost basis is what you originally paid for the home plus every capital improvement you made over the years. A new roof, a remodeled kitchen, a replaced furnace, a new deck, a finished basement, Those all increase your cost basis and reduce your taxable gain. If you have lived in your home for 20 or 30 years, those improvements can add up to tens of thousands of dollars, maybe even 100,000 or more. IRS Publication 523 explains exactly what counts as an improvement versus a repair. Improvements add value or extend the life of the home. Repairs simply maintain existing condition. A new roof is an improvement. Patching a leak is a repair. And here is a special rule many people do not know. If your spouse passed away and you sell the home within 2 years, you may still qualify for the full $500,000 joint exclusion if the sale occurs in the year of death and you file a joint return for that year. There is also an exception to the 2 out of 5 year use test for individuals with a disability. That is in Publication 523 as well. The bottom line is this: keep your receipts, keep your contractor invoices, keep your permit records. They are worth real money. Failing to track improvements can trigger capital gains tax of 15 to 20% on gain that should not have been taxable. On $50,000 of improperly calculated gain, that is $7,500 to $10,000 in unnecessary federal tax. Deduction number 4. Qualified charitable distributions from your IRA. This one is powerful, and it is almost always done wrong. If you are 70 and a half or older and you have a traditional IRA, you can donate up to $108,000 per year directly from your IRA to a qualifying charity. This is called a Qualified Charitable Distribution, or QCD. This is documented in IRS Publication 590B and Publication 526. Here is why this matters so much. A QCD is not a deduction, it is an exclusion. The money goes straight from your IRA to the charity. It never shows up as income on your tax return. It simply does not exist on your Form 1040. And here is the bonus. A QCD counts toward your required minimum distribution for the year. So instead of taking your RMD, paying income tax on it, and then donating the money to your church or charity, which gives you zero tax benefit if you take the standard deduction, you do a QCD. The money goes directly to the charity. You satisfy your RMD, and your taxable income stays lower. That lower income can keep you below the threshold for Social Security taxation. It can prevent Medicare IRA surcharges from increasing your premiums, and it can keep you eligible for the new Enhanced Deduction for seniors we just talked about. But here is the critical mistake. The money must go directly from your IRA custodian to the charity. If your IRA sends you a check and then you write a check to the charity, it does not qualify. The IRS will treat that as a taxable distribution, even if you donated every penny. You will owe income tax on the full amount. Tell your IRA custodian to send the money directly to the charity. That is the only way this works. And one more thing. QCDs cannot be made from SEP IRAs, simple IRAs that are still receiving contributions, 401k plans, or to private foundations and donor-advised funds. The charity must be a 501c3 organization. At a 22% tax rate, a $10,000 distribution donated the wrong way costs you approximately $2,200 in completely avoidable federal income tax. Deduction number 5. The credit for the elderly or the disabled. This is the one I told you to stay for, and it is not technically a deduction, it is a credit, which means it is even more valuable. A deduction reduces your taxable income. A credit reduces your actual tax bill dollar for dollar. Under IRS Section 22, if you are 65 or older, or if you are under 65 and retired on permanent and total disability with taxable disability income, you may qualify for a tax credit of up to $7,500. You claim it on Schedule R, Form 1040. The complete instructions are in IRS Publication 524. Now, there are income limits. For a single filer 65 or older, your AGI generally needs to be under $17,500. Your non-taxable Social Security must be under $5,000. I know what you are thinking. That is very low, and you are right. The thresholds are low. But here is the thing. There are millions of seniors in this country living on very modest incomes. Many of them rely almost entirely on Social Security. Many of them assume they do not even need to file a tax return. But if they have even a small amount of other income, a tiny pension, a little bit of interest from a savings account, they might owe a small tax bill. And this credit could wipe that bill out completely. This is one of the most underclaimed credits in the entire tax code. Most tax software skips right past it. Many accountants do not even ask about it. And here is something most people do not know. If you're not sure how to calculate it, you do not have to. Fill out the front of Schedule R with your information. Write the letters CFE on the dotted line next to line 20 of your Form 1040, and the IRS will calculate the credit for you and send you the result. If you visit a VITA or TCE free tax preparation site, the volunteers are specifically trained to look for this credit. This is what they do. All right. You now know 5 deductions and credits that could save you hundreds or even thousands of dollars every single year, but knowledge without action is worthless. So here are the 3 steps I need you to take this week. Step 1. Download or request your free IRS publications. Go to IRS.gov/forms, search for these publication numbers and download them. They are free, they are in plain English, and they are yours by right as a taxpayer. Publication 554. That is the tax guide for seniors. It is your master document. Publication 502. That covers every medical expense you can deduct. Publication 523. That is for selling your home and calculating your true cost basis. Publication 524. That explains the credit for the elderly or disabled. Publication 590B. That covers IRA distributions and the QCD rules. If you do not have a computer, call the IRS at 1-800-829-3676 and ask them to mail these publications to you. That number again is 1-800-829-3676. They will send them free of charge. Step 2. Pull out your 2025 tax return and review it. Look at it with fresh eyes. Ask yourself these questions. Did my preparer claim the new enhanced deduction for seniors on a separate line? If you are 65 or older and your income is under the phase-out limits, it should be there. Did I have major medical expenses last year? If so, did my preparer compare itemizing versus the standard deduction? Did I sell my home? If so, does the return show my adjusted cost basis, including capital improvements, or just my original purchase price? Did I make charitable donations from my IRA? Were they processed as QCDs directly from my IRA custodian to the charity? Is my income low enough for the credit for the elderly? If so, is Schedule R attached to my return? If you find that something was missed, you have 3 years to file an amended return using Form 1040X. 3 years. So your 2023, 2024, and 2025 returns can all potentially be corrected. Step 3. Take advantage of free tax preparation services built specifically for seniors. You do not have to pay someone $300 to file your return. The IRS funds 2 free programs designed for you. The first is called Tax Counseling for the Elderly, or TCE. It is free for anyone age 60 or older. Call 800-906-9887 to find a site near you. The second is AARP Foundation Tax Aid. They have thousands of locations in libraries, community centers, banks, and senior centers across the country. Call 888-227-7669 or visit aarp.org/taxaid. These volunteers are specifically trained to identify senior-specific deductions and credits. They know about the enhanced deduction for seniors. They know about QCDs. They know about Schedule R. This is what they do, and it does not cost you a single penny. Now, before I let you go, I need to talk to you about something important. Tax rules change. They change every year. The enhanced deduction for seniors we discussed today, it expires after 2028. Income thresholds get adjusted for inflation. New laws get passed. Old rules get modified. If you rely only on YouTube to stay informed, you are going to miss things. YouTube does not always show you my videos. The algorithm decides what you see, and it does not care whether you are about to lose a deduction or miss a filing deadline. That is exactly why I built something specifically for you. In the description below this video, you will find a link to join the Global Senior Alerts official WhatsApp channel. When you join, you will be able to download a free senior benefits protection guide. It lists every IRS publication number, every phone number, every website, and every deadline you need to know, all in one place, and you will receive real-time alerts whenever there is a change to Social Security rules, tax deductions, Medicare policies, pension regulations, banking rules, or travel regulations that affect seniors. No spam, no selling, just the facts delivered directly to your phone the moment something changes. Click the link in the description right now. Join the channel, download the free guide, and share this video with one person you care about: a spouse, a sibling, a friend, a neighbor. Someone who might be sitting at their kitchen table right now, overpaying the IRS by thousands of dollars because nobody told them what I just told you. These 5 deductions are not hidden. They are not secret. They are published on IRS.gov for the whole world to see. The problem is that nobody is connecting the dots for you. That is my job, and I will be here every single week doing exactly that. I am Edward. Thank you for watching, and I will see you in the next one.